The SEC just approved options on Blackrock's ETF IBIT. This is going to change the game for Bitcoin. Again, it's going to have massive implications, and I'm going to explain to you why. Hey guys, I'm Sina, business professor and a co-founder of 21st Capital. I'm very excited today to talk about a news that just came out. Today, the Securities and Stock Exchange Committee approved options trading on top of Bitcoin ETFs. Remember how big and important the Bitcoin ETFs were? This is now in this similar order of magnitude, the effect it might have on the future future of Bitcoin, because it opens a completely new market and brings in a new batch of institutional and individual participants. Okay, so let's see what just happened. Here I have the actual announcement on SEC's website. You can see that NASDAQ ISE had filed an application with the SEC, which was granted today after a few modifications. The original filing was occurred in January, right when they actually got approval for the Bitcoin ETFs. And right after that, they followed up and they pursued the SEC to get approval for the options. It took them about 9 months to go through all the hoops and all the paperwork, but it's done now. And as you can see here, these are going to be American style options. Here's a table that shows the different organizations that were involved in the approval of these options and the role they played and a timeline. You can see that the Blackrock is the original beneficiary, and the NASDAQ ISE is the exchange on which the options will be traded. Therefore, they were the ones that filed with the SEC and pursued the approval. They began this in January, and the SEC just approved it. And what is left is for OPRA, Options Pricing Reporting Authority, to provide the infrastructure for option price reporting. A price is very, very important for a lot of the SEC's approvals, and they went through the same thing with the approval of ETFs, because they really want the price to be very difficult to manipulate. And if certain participants come in with huge buys or sells right when the price is being recorded, perhaps at the end of the day or at the expiry of the options, those huge buys can create major swings in the price at the last minute and cause the other parties to lose money. And this sort of manipulation is basically what the SEC is worried about right now. The way they treat it is, first of all, they work with their approved partners to collect price information, but they also collect the price information not just in the last few seconds. They sample a few hours of trading, and then they trim the tops and bottoms. They play some statistical games with it so that they get a reliable benchmark number that's very difficult to manipulate. Those details are not necessarily important to us, but that's where we are right now with these options. Once that is approved and once FINRA puts in place sufficient market surveillance to again prevent manipulation and collusion and prevent big players from cornering the market and playing games like that. And if they're happy that the options trading is compliant with the rules, then they'll give it the final go ahead, which I'm not really expecting to take a whole long time. And after that, trading could resume. Okay. Now, let's see why this is important at all, right? So first of all, these options allow an additional layer of complexity on Bitcoin, and it enables the market to be much more liquid and efficient. Here, I have an example for you. Before options being available in the traditional markets, people had to use the dead FTX or Deribit or a few other exchanges for trading options. And these options were really terrible because they were not liquid, and the gap between bid and ask prices were really high. Here, I have an example. So I'm looking at Deribit pricing right now. If I scroll down, well, on the left, you see the call options, which allow you to speculate or essentially secure a purchasing price in the future. And on the right, you have the put options, which allow you to secure a selling price in the future. Essentially, that's why they're called options, because they give you the option to buy or option to sell, but not the obligation of it. So here you see a bunch of, each line is one contract. You see the current price is 63,000. And let's say we want to bet that in a few months, the price of Bitcoin is going to be $10,000 higher. So that's going to get us to somewhere like 74,000. Okay. And if you want to bet on something like this, you're going to buy this contract. And what you have to pay is written here. These are the parameters of this option. And if you want to buy this contract, you'd have to pay $978. This is the ask price, and the best bid price is $915. You see, it's a quite significant gap between them, $60 of gap. If you want to buy this contract right now and immediately sell it, you're going to be out by $60 just because of the lack of liquidity. This gap gets wider if the market is not liquid, and once more participants join and trading activity picks up, the liquidity will increase and the gaps between these contracts will go down. So everyone buys at a cheaper price and sells at a better price. And this is exactly what's going to happen in the Bitcoin market after the approval of these options in the traditional market, where all the big institutions are there and big money is there. And as options trading begins in those markets, you see extremely efficient and tight bid-ask spreads, which will benefit all the investors. Okay, so moving on with our example, essentially, looking at the left again, the call option would allow me to get an option to buy Bitcoin at $74,000. There is a cost to get that option, which is what we just saw, $978. If I pay that cost, I have secured the ability to purchase Bitcoin at $74,000. How much can I buy? It's a function of how many contracts I have purchased, and for each contract, I have to pay a premium. So immediately you are in loss because you just paid the premium. But if the price goes up, and especially passes the number that you predicted, then you begin making significant profits. And the second benefit of these options is it allows financial market participants a wider variety of options and a wider variety of trading strategies, such that they can really define the risk and manage the portfolios a lot better. This will attract a lot more players, a lot more money, and a lot more institutions in Bitcoin. Now, to make sure we really understand what's happening, I have an example here for you. Assume we're talking about a stock, which is called ABC Company. And there is a specific option contract among many others that will have a strike price of 50. This essentially means this is the option to buy this stock at 50. It's not an obligation, but it gives you the option to purchase. Now, to get that option, you have to pay a premium of $5. So, and also let's say it expires in 6 months, because there's typically an expiry date. A contract is not indefinite. It has a limited time period. So if 6 months from now or any time in between, the stock price is higher than 50, it's awesome for me because I have the option to buy it at 50. If it's 60, I will still be paying 50, and then I'm going to be profiting from that $10 gap. So here, if you just want to play the traditional game in the stock, you can buy shares of it. Let's say you buy 100 shares of it, and remember, each share was $50. So to buy this much, you'd have to pay $5,000. Notice $5,000 of your funds are now stuck in this security. And well, of course, if it goes up, you benefit. If it goes down, you lose. So you can lose all of it, or you can gain a lot, according to the stock price. But Now, a second option that was just made available to you because of the options is for you to buy, for example, a call option. Let's say each contract gives you the option to buy 1 share. And if you want to have the option to buy 100 shares, you have to buy 100 contracts. Each contract goes for $5. So the cost of this strategy would be $500. So what are you getting for $500? Right now you get nothing. So you're just at a loss. You just lost $500, but you now have the option to buy the stock at 50. Now, if the price goes up in future, your price is now fixed at 50, which is great. Now, if the price goes down, or let's say if the price stays at 50, so there's no change in the price, well, that's not a great scenario for you because you just have a bunch of options that gives you the option to buy at the market price. So it's not really a benefit. You can just go to the market and buy it. And the only thing that happened is you lost $500. But the magic happens when, let's say you made a significant mistake and the price really goes down. Because you haven't purchased the actual price, you're not really getting hurt by the price of the asset going down. So if the price goes to 40 or 30 or anything, you're still only out by the premium you paid. But if you had purchased a large block of the actual stock, well, you'd be continually losing more and more as the price goes down. So your risk is now defined. You can only lose this 500 premium that you paid for the contract. And this is an amazing feature for some sophisticated financial player or an individual that just wants to have a capped loss in their trade. Now imagine the price goes higher than 50 and reaches 55. That's our break-even price. What do we mean by break-even? That means the loss that was caused because you had to pay the option premium is now offset by the benefits or profit in that option. So essentially what happens is the price moves on to 55, but you have the option to buy at 50. So for every single contract that you have purchased, you are now in profits by $5. And because you have 100 contracts, you have $500 of profit, and that gets offset by the premium. So you're essentially made nothing and you reach break even. But it's a good position to be in because any increase in the price of the asset is going to have significant benefits for you. And let's say the price continues to go higher than 55 and reaches 60, again, because it's now $10 higher than your strike price. On every contract, you make $10, and therefore you make $1,000 there. Subtracting the premium gives you $500 in profits. So here's essentially a more dynamic way to demonstrate this. If the price of the stock drops to 0 or 10 or 20 or any other number, as you can see in this chart, your loss is capped, but your gain is unlimited. So as soon as you pass the $55, which is the break-even price, you're in a honeymoon phase because the higher the price goes, you simply accumulate more and more profits without really having invested much money. You only put in $500, but now you have the option to buy 100 units of that stock at a fixed price and sell it at a much higher price. Okay, so that was a call option, but you can also do other kinds of options. And another simple type of options is a put option that gives you the option to sell security at a predetermined price. And that's also amazing because it gives you the hedging capability. If you have purchased a bunch of Bitcoin and you're worried that it might drop significantly, you can get the option to sell it at a specific price. And if the price later drops below it, that option keeps your price fixed. And so you stop losing more and more. This also gives market participants the ability to hedge their risk better and again makes Bitcoin more attractive for them. And I show this in this chart as well. If you purchase a put option, your stance on the asset is bearish, so you are worried that it might drop in future. Beginning from the center of the graph, if the price drops further down, you're fine because actually you make money after you quickly recoup the premium you paid, and then any further than that, you are in the money because you have the option to sell it at a much higher price than the market price. But if you're totally wrong and it doesn't drop and actually keeps going up, your loss is limited to the premium you paid. So it's not like shorting a security, which implies unlimited loss. Here, your loss is capped. So another great strategy getting unlocked by the options market. And purchasing call options or put options are not the only thing you can do. You can actually sell them as well and reverse the strategy. Or we can play a sophisticated combination of call options and put options to really and carefully define the maximum loss and the maximum gain that you're going to have. So here's an example. You can play a call spread strategy, for example, as I have in this part of the graph, where you buy a lower priced call option and then you sell a much higher priced call option. And what that's going to do is it gives you the ability to benefit from price appreciation with a capped loss. But also, because you think the price can go up to a certain point, but not beyond that, you can sell the upside from that point on to actually acquire some extra premium and reduce the cost of your strategy. So essentially here you can do something like, I only bet on the price of Bitcoin going from whatever it is today by $20,000 within the next quarter. And I only want to benefit from that just to collect some extra premium and reduce the cost of the strategy. An endless number of other strategies that financial players can execute. And this is what Wall Street loves. If you're a really big company, say MicroStrategy, their only play is to be levered long Bitcoin, and they have no ability to hedge their risk onto the downside or limit the volatility or exercise some information they have about the probability distribution of the price of Bitcoin in the future. So if you have some insight in terms of some level of expectation about where the price might be, and if that's different from what the market thinks, you can place an option bet and really carefully define your benefits and losses in a variety of scenarios. Do you think, say, Michael Saylor would love this? You bet. Do you think major investors in Blackrock would love to join the options market? Of course. Another thing they can do is if they are long Bitcoin in the spot market, if they're long the real Bitcoin, they could actually add some hedging strategies through the options to cap their loss. And this will enable them to take bigger positions and bring in larger amounts of money to purchase more Bitcoin, because now they have much better ability to limit the downside. All right, guys, that's it. I hope you liked this video. I'm very, very excited about what just happened. And this is another one of those examples like the approval of the ETFs, which is extremely big and brings in a ton of new money into the space and invested in Bitcoin. And then it has the potential to be missed and ignored by many people because they're not aware of the role of derivatives and options and the benefits they can bring to an asset class. So what we are expecting moving forward is better liquidity in the Bitcoin market, bigger financial players becoming more and more confident in bringing their money into the space, and more confidence and maturity of the market as a whole. Another benefit of this is this will dampen the volatility of Bitcoin, because a lot of the holders, a lot of the whales that previously would have to have, for example, sold a massive block of their holdings because, say, they're worried about price dropping, they don't need to sell anymore. They can simply purchase a put option and hedge their position and avoid causing the market to crash, and also avoid a lot of the tax obligation that will be triggered by selling this in the spot. So this has significant positive benefits for Bitcoin, but it's not going to happen overnight. This is something that just strengthens the fundamentals of the market and makes us even more bullish. If you like this video, please like and subscribe. This will tremendously help the channel. And you can also find us at 21stcapital.com if you have any questions about Bitcoin security custody or financial side of it. Thank you guys. I'll see you in the next video.